For the sake of our viewers, let's just first understand this T+3 transition to T+2. How significant is this for the markets at this time?
What this does is that it shortens the transaction cycle. So now you have transaction day plus 1 plus 2, you get both your cash and your shares. Ideally, what that does is that, when you have access to your cash earlier than normal, you can always deploy that cash to do something else. And we've had situations where people are in a hurry. They sell their shares, borrow money to fulfill their obligations, and then wait till the third day to return the borrowing, or rather refund the money. So by doing that, what it means is that we're providing earlier liquidity than it used to be. And so by extension, you can do more things thereafter. So in a nutshell, that's what it is. But to answer your question directly, there is a company called Value Exchange that has been tracking globally the settlement cycles and the impact in terms of liquidity. Like I mentioned downstairs, what you find is when markets move from T+3 to T+2 or T+1, particularly if I remember the numbers for T+1, is that you see liquidity drop the first 3 months or less, but then subsequently it goes up by anything between 8 and 17 or 16%. I remember the exact data, or even more in many cases. So it's not going to be different from our own. We have arguably 25,000 trades a day. And what you'll likely see is that there are likely to be more trades because people have now earlier cash to begin to go back or reinvest into the market. And in the context of that, it means that by extension, there will be some liquidity that will increase.